Okay, so we are back from Easter vacation. If you're like me, you didn't do a heck of a lot, maybe a little yard work, binging on some TV shows, who knows. But we come back to some interesting things happening in the economy. So today is Tuesday, April 21st, and yesterday it was announced that a very odd and interesting thing happened in the market for oil, crude oil. The price actually went negative for oil that is going to be delivered in May. So that's called futures. People are investing in selling a product that is being manufactured at this point, in this case of oil extracted from the ground at this point, crude oil, and is going to be delivered in May. And there's also a different market where people are trading for what they call oil futures in June. Well, the May oil futures actually went negative earlier this morning, I guess. What does that mean? It means that for delivery of crude oil in May coming up, that American oil companies don't have anywhere to put the oil. All of their tanks, storage tanks, are full. Everything, they've even been renting barges and having them off the coast and filling those barges, holds with oil. They don't have anywhere to put the oil. So the value of any new oil is zero. In fact, it's less than zero. Oil companies are actually willing to pay someone to not deliver the oil to them in May. Now, the futures for deliveries in June are still, this morning when I drove in, we're still sitting at $21 per barrel. That will probably go down also. So more oil is being pumped out of the ground than can be processed into gasoline and sold. So that's all kind of a microeconomics review of supply and demand issues. And, you know, we keep saying that prices can't go negative. We just need the upper right quadrant when we do economics. Well, suddenly we need the lower right quadrant too for negative prices. Very interesting situation. All right, today's information is about Chapter 35, Money and Banking. We had a video before Easter on the creation of a bank, how banks get created. I explained to you about an accounting technique called using T accounts. Remember what a T account was? It had assets on the left-hand side, and it had liabilities and net worth on the right-hand side. Okay, and I was talking to you about double entry bookkeeping, where anytime we have a transaction, it gets entered in two places. Sometimes it gets entered on the left and on the right together. And sometimes there's two entries on the left, a positive one and a negative one. And sometimes two entries on the right, a positive one and a negative one. When you take an accounting class, you'll get more information and understand that a little bit better. But they always have to balance. The two sides always have to balance. So remember all that from before Easter. That video is still posted. You can still go back and click on it and take a look at it. We talked about how a bank gets started, the initial deposits, accepting deposits from customers and setting up what I call demand deposits. Your book calls checkable deposits. And how that worked. The checkable deposit is a liability for a bank. It owes it back to its customer, but it's also an asset because it has the cash. The cash is in the reserves for the bank on the left-hand side. So the cash reserves are an asset. The liability is that they owe the money back to the person when they write checks or buy things with their debit card. Buying government securities. Banks sometimes use the money they have, that is their cash, that they don't owe back to anyone else. Actually, sometimes they use the money that they owe back to other people, their reserves, to buy securities, buy government bonds. And sometimes a bank will even purchase a corporate bond or other kinds of securities, whether it's government securities or private securities. banks invest in those kind of things because they're sure bits of income for them. The process of making a loan. When a bank makes a loan, it lends out, if you recall, some of the reserves that it has in assets over here are required reserves by law. And currently in the United States, banks are required to have 10% of their outstanding checkable deposits in reserve. So that's the required reserves. Many of the examples in our textbook used a 20% reserve ratio, okay? Those are required reserves. And then a lot of times banks have excess reserves. And if they have excess reserves, they can do one of two things with those excess reserves. They can lend them out to another customer who comes in for a loan, or they can buy government securities or corporate securities with those excess reserves. Or they can just let the excess reserves sit there, not earning anything, okay? And actually, like I think I explained at the end of that video before Easter, that in recent years, since the 2008-9 recession and the laws that were passed to alter banking a little bit since that time, the Federal Reserve actually does pay a very low interest rate on the reserves, the excess reserves that a bank has sitting in the Federal Reserve Bank vault. So sometimes the excess reserves just sit there. And in fact, that's what is happening in all of banking in the United States today. All banks have an incredible amount of excess reserves that they're not looking to lend out. They're not looking to purchase securities with it or anything like that. They're just sitting on that money. So you remember the difference between required reserves and excess reserves. A loan can be made when the bank loans out excess reserves. And when the bank loans out those excess reserves, that creates brand new money in the economy. That was the crucial thing that you learned before Easter in that last video. A loan creates new money that didn't exist before. And that's money in our system that was not created by the federal government. It was not created by a state. No level of government created that money. A private bank created that money by making that loan. What I didn't follow up on, I think, before Easter is that when a loan is repaid, money is destroyed. That money is taken out of circulation. So let's say that a guy borrows $100,000 from a bank. The bank gives him its excess reserves, $100,000. He now has that to spend in the economy. That's new money in the economy that didn't exist a minute ago. The bank now has a loan payable to itself, an asset, a loan receivable, rather, an account receivable that it can receive from that guy as he makes payments. Now, let's say that his contract said that no payments are due on this money for 1 year. And in 1 year, the entire loan is due to be paid off all at one time. So a year from now, that guy pays back the $100,000 all at once, and that money is taken out of society, out of circulation. It's destroyed. It existed for a year, and then it was destroyed, okay, by paying off the loan. Of course, in the real world, we pay loans off month by month. We make monthly payments on our loans, and as we make those monthly payments, money is going out of circulation. But the banker is making new loans every month. He's making about as many loans as people are paying off in any given month. And so that's why the money supply stays pretty constant over any given period of time. Now, what's important today, what this video is all about, is that a single bank can only lend out its excess reserves. It can't lend more than its excess reserves. So if it has $8,000 in excess reserves, it can lend out all of that $8,000, but no more. It may have, $30,000, $40,000, $50,000 in reserves, most of which are required reserves. It can only lend out its excess reserves. The best way to make sure you understand this is to look at some of the homework problems. So due today at noon were the homework for chapter 35. And let's take a look at number 2. It was about Serendipity Bank, if you recall. It has excess reserves of $8,000 and checkable deposits of $150,000. If the reserve ratio is 20%, what is the size of the bank's actual reserves? So I've done on the board here. $150,000 are the checkable deposits, what I call demand deposits, DD demand deposits. 20% of that is $30,000. That's the required reserves. We're told in the problem, number 2, that they have $8,000 in excess reserves. They have $38,000 in total actual reserves. Total reserves are actual reserves. Okay, 30,000 required plus the 8,000 excess, 38. That's the answer to number 2. Number 3 talks about a different bank, Third National Bank. Before the deposits that are discussed in number 3, it says that it has reserves of $20,000 and checkable deposits of $100,000. The required reserve ratio is 20%, so it has exactly as many reserves as it needs. 20% of $100,000 is $20,000. So before the new deposits are made, there are no excess reserves at Third National Bank. Then customers come in and deposit $5,000. Households deposit $5,000 in currency into the bank, and that currency is added to the reserves. What level of excess reserves does the bank now have? Well, the bank's total amount of demand deposits went from $100,000 to $105,000 in demand deposits because of the $5,000 that was deposited. 20% of that is $21,000. Multiply that out, you get $21,000 required reserves. They had $20,000 in reserve. They accepted another $5,000 in cash. They now have $25,000 in reserves, 21 of which are required reserves. They've got $4,000 in excess reserves. And then the next question, number 4 says, suppose again that Third National Bank has reserves of $20,000, checkable deposits of $100,000, so they're right where they need to be. The bank now sells $5,000 in securities to the Federal Reserve Bank in its district, receiving $5,000 in increase in their reserves in return. So in this case, instead of the demand deposits going up to 105, demand deposits still remain $100,000. They had a bunch of securities on their assets side of their liability of their T account here, their balance sheet, and they sold $5,000 of U.S. bonds to the Federal Reserve. The Federal Reserve gave them $5,000. So add that to their $20,000 they already had in reserves. They now have $25,000 in reserves. Checkable deposits are still $100,000. $20,000 is all that's required to be on deposit on that. So now they have $5,000 in excess reserves. And the answer to the question, how does the amount of excess reserves differ from the previous question? And the answer is by $1,000. So hopefully you understood those questions. I'm going to go over problem number 5 and number 6 in a future video. And I'm also going to go over the discussion questions in a future video. So at this point, that's basically just a review of what we did before Easter. And I'm going to end this video at this point. The next video, which I recommend you watch right away, is going to be on the multiple deposit expansion of the money supply. Okay?